Hello and welcome to our latest Insider interview. Today I'm joined by Job Curtis, Fund Manager of the City of London Investment Trust. Job, great to see you again.
It's a pleasure.
So Job, as you mentioned in a recent note to investors, UK companies, they're attracting attention from potential overseas buyers, including private equity firms. However, retail investors, they're continuing to shy away from the UK stock market. Why are they shying away and what needs to happen for that to change?
Well, everybody's gone very global, I think, in UK investors. And obviously, if you invest, say, in the American market, you've got the sort of leading technology companies, which you just can't find the same equivalent in the UK. And so I can understand why people, do want to have a lot of global exposure in their portfolios. But, there is a lot of value in the UK, in my opinion. I mean, certainly, even stripping out the fact that we don't have the big technology companies, we got one or two, but nothing like the kind of Microsofts, Apples, etc. If you look at our companies on a like-for-like basis compared with companies in other stock markets, there's a big valuation discount. Some people measure it as much as 20%, and it can be higher in certain cases. If you look at like oil company Shell versus US oil company Exxon, it's more than 20% valuation discount. So as we've got a pretty open system for corporate control, and so there have been a lot of takeovers. I mean, on City of London, Brewin Dolphin, the wealth manager was taken over by Royal Bank of Canada as an example. Morrison's supermarket was taken over by a US private equity group, but that's just two small examples. I mean, there've been a lot. And I think while this sort of valuation gap persists, I think you're likely to see more takeovers. I think that all I can say is that you're being paid while you wait in the UK stock market. It throws up a very decent dividend yield, and for those want to be patient, you can enjoy a decent dividend yield, and eventually, in my view, the valuation gap will close, but it could take time.
You mentioned the dividend yield, and I think the yield on City of London's over 5% at the moment. But equities now face greater competition from other assets, which are viewed as lower risk, so cash-like investments and bonds. And those yields, they've risen in response to interest rates going up. So could you make the case for UK equity income over those two alternatives?
Yes, I certainly could. I mean, the thing about equity income is it derives from dividends, which are derived from the profits of companies. So to the extent that companies can grow their profits, they can also grow their dividends. So in the long run, you get dividend growth, whilst fixed interest, whether it's bank deposits or bonds, is essentially fixed. And so, which I think is particularly important in a period when you've got inflation. And so in real terms, if you've got a fixed rate deposit or bond, if you've got inflation around 8%, you're actually, within a year, your money's lost 8% of its purchasing power. So whilst in an equity fund, at least you've got the growth in income, which can alleviate that inflationary effect.
In terms of dividend growth, City of London has a remarkable track record. So you're one of 8 investment trusts that have increased their dividend payouts each year for over 50 years or more. So are you on track to deliver a 57th year in a row?
Yes, we've guided to the market that we will increase our dividend by 2.6% this year, so it'll be our 57th year. I mean, obviously that is below the current rate of inflation, but the board aims to achieve at least inflation over the economic cycle, and over the last 10 years, we're well ahead of inflation in terms of our dividend growth. But obviously, in certain markets, it's particularly when you've got very high inflation at the moment, it's quite difficult to actually get as high as inflation.
And I assume the dividend track record that you've got, both yourself and the board are keen for that to continue for as long as possible, especially as we're approaching 60 years in a short amount of time.
Yes, absolutely. I mean, obviously, at our core, we have consistent companies, leading companies with leading market positions, with kind of strong brands and kind of moats around their business, and that's really important. But ultimately, we also have reserves, and investment trusts have this structural advantage that they don't have to distribute all their income in any one year. So in the difficult years for income, like we had in the first year of the pandemic, when FTSE 100 dividends were down by around 36% and bigger outside the FTSE. And in that type of year, we were able to draw on our revenue reserve to help continue growing our dividends. So there's no way we could have achieved our record without those revenue reserves, and we draw down on them in the really difficult years. But in the good years, we can put money back into our revenue reserve.
So how healthy are the revenue reserves? If you did have a big income shortfall from the underlying holdings, how much of the dividends could those reserves fund?
Well, they're decent, our revenue reserves. They're slightly under half the annual cost of our dividends, so they should tide us through on any but the most extreme conditions. I mean, they're also another form of reserves called capital distributable reserves, which basically are the net profits you realised over the years, net of any losses you might have made. And those are very substantial. I mean, those are more than 3 times the annual cost of our dividend. We don't think we certainly wouldn't want to ever use those distributed capital reserves, and we don't think it's likely, but they are there as an ultimate backstop.
As well as the dividend reserves, one of the other bells and whistles that investment trusts have is the ability to gear, which can be very, very beneficial in a rising market. So your gearing level is currently around 8%. What's the typical range for City of London, and what would need to happen for you to increase gearing levels?
Yes, I mean gearing, we've got some very cheap debt which we've issued in recent years during the period of ultra long interest rates. So we've borrowed £50 million at 2.94% and £30 million at 2.67%. That's going out for 25 years. So we've locked in some very cheap borrowing rates for our shareholders for the next quarter of a century. And so that accounts, our fixed rate borrowings account for around 6% gearing, and that remains invested in the market. I mean, our portfolio is a fairly conservative portfolio, and it kind of tends to be less volatile than the market. So it lends itself to a bit of gearing, particularly in a rising market. And we've kind of, as I say, borrowed at very cheap rates. In addition, we have a bank facility where we can borrow short term, and we've actually reduced that quite markedly recently. Obviously, with the short term, the base rate is now 5%, and we're paying a margin over that. It's not quite so attractive to be borrowing short term. So our gearing is, slightly above 6%. We've reduced it really, given the kind of higher interest rate environment. But I think the fixed rate borrowings are very much there strategically for the next quarter of a century, and I'd be very disappointed if we can't beat those interest rates, over that time period.
And with the gearing levels, are you making a call on the market, or is it when there's new opportunities that present themselves that you then use the facility?
Yes, a bit of both. I mean, I think, as I said, the fixed rate is strategic, a longer term view, but then the bank facility is more tactical, and certainly if you get a big sell off in the market and things look really good value again, then we can go in, start using that bank facility. So that would be as opportunities present itself both on a stock level and on a market level.
And you mentioned the gearing level is now 6%. How does that compare to sort of typical average?
Yes, it's at the lower end of our range. I mean, our range is probably around 5 to 6 at the lower end, to about kind of 14 is probably the maximum it's been in recent years. So we tend to be we're pretty conservative with the gearing, but it does, as you say, it's one sort of structural advantage that investment trusts have in it. Markets do rise most of the time, and it is something that does add to returns.
So you've managed City of London Investment Trust since 1991, which is a remarkable track record, and it's very rare, especially nowadays. Now, I'm sure your shareholders don't want you to hang your boots up anytime soon, but I think it'd be remiss of me not to ask, is there some succession planning in place?
Yes, there definitely is. I mean, I love managing City of London. I want to continue to do so. I was only age 30 when I became appointed manager, but I work in the global equity income team at Janus Henderson, and with 12 investment professionals. But in particular, I work with David Smith, who is the appointed deputy fund manager of City of London. He was appointed 2 years ago, and he and I have worked together for over 10 years, and he manages some other portfolios as well. And we work very closely, and certainly if something was to sort of happen to me, he is absolutely placed to take over.
And our final question is the skin in the game question, but it's one I've asked you before. So instead, I wanted to ask you to explain why you think it's important that fund managers do have some skin in the game, and they eat their own cooking.
Yes, well, I think it's exactly that. You wouldn't want to go to a sort of a cook who'd, if someone cooked you a nice meal and then they didn't eat it themselves, you might get a bit suspicious. And so, yes, I've got over £1 million in City London shares, and I'm really pleased to have. I mean, for me, it's obviously said, I'm in a stage of my life where I've got that savings to be able to make that. But no, I think it's quite important that a fund manager should have a decent investment in the fund he manages.
Job, thank you for your time today.
It's a pleasure.
That's it for this episode. Hope you've enjoyed it. Please do like, comment and subscribe, and I'll hopefully see you again next time.